There's a really interesting phenomenon happening with interest rates right now. You probably know that the Fed lowered interest rates by a 0.5% or 50 basis points about a month ago. But you may not know that interest rates have been creeping back up since then. And actually, between last month and now, they're up about a 0.5%. Why is that? The first thing you have to understand is that the interest rate that the Fed lowers is the Fed funds rate, and that is only the interest rate that they lend out to the highest quality banks overnight. So it's a very short-term interest rate to extremely high quality borrowers. Other interest rates, like the 10-year Treasury or the 30-year mortgage, are based a lot on supply and demand. 10-year mortgage and the 10-year Treasury and the 30-year mortgage are actually really highly correlated. But the 10-year Treasury can be influenced by a lot of things. The Treasury has to auction off these securities, and even though they're really low risk, if there's not enough demand for the supply that they have, they're going to have to increase the rate a little bit to drum up some more demand. And this can happen when the economy actually looks pretty good. When investors don't see a lot of benefit to choosing the low risk security with not that great of a return, and they feel like the market offers something better for them, then they're not going to buy treasuries at the auction. The Fed's going to have to raise the rates on what they're offering to get people interested, to get people to show up. There are also other sovereign nations that are offering better interest rates right now than we are, and they may not be quite as good quality as the Fed's securities, but investors have a little bit of a risk for or appetite for risk right now, so they're pretty much okay with that. And then the final thing that can cause, and likely is causing rates to increase a little bit right now, is an increase in supply. If the Treasury stops buying its own securities, or if they need to issue more bonds in order to pay for Congress's spending, then they need to increase the rate that they're asking, or that they're willing to pay investors to take on that debt, to increase the number of people that show up to bid on them. So how does that affect you as a bond investor? Well, when interest rates go up, that's fantastic for you if you're buying a new bond, because you get that pretty high new interest rate. It's not fantastic for people who already own bonds. Your existing bond portfolio doesn't look too hot when rates are going up, because if you were to go try to sell your bonds to someone else, they wouldn't want them. They would much rather have the new bond with the new interest rate. And so you have to sell your bond for a discount to basically help compensate for the difference in interest rates. Now, typically investors like bonds not just for the income, but for the volatility control they provide. And when we're in an interest rate environment when we're in an environment where interest rates are rising or even just fluctuating, going back and forth, bonds really don't have as much volatility control as a lot of investors would like. So what's a bond investor to do in this type of situation? In 2022, the long-term Treasury was down 30%, as much as the NASDAQ, but the long-term Treasury is still depressed from its highs in 2021. And I really don't see that changing in the near future with all of this interest rate risk still present. If you're really intent on bonds, the best place to be right now is in short and intermediate term fixed income, really. I would still just stay away from long-term bonds because they're much more affected by fluctuating interest rates, the prices are. And the other thing is, if you have any appetite at all for market risk, consider a high dividend equity portfolio. We have a really great one, Current Equity Income. We target a 3.5% to 4.5% dividend yield all the time, and we've even had the dividend yield higher at some points. The really great thing about a high dividend equity portfolio is that you have individual stocks that can grow with the market. You have the potential growth of stock ownership, but you're also getting paid at the same time. And we choose stocks that always pay their dividends. So it really feels more like an interest rate off of a bond. You do have the more market volatility in general and fluctuation, You have that really solid dividend there that's paying you to wait for the securities to come back. And so really these high dividend portfolios, they are a little bit less sensitive to interest rates than a traditional bond portfolio is. Plus you have all that upside that you don't get from the bonds. If you have questions about what to do with a bond type of portfolio, or you're interested in learning more about something like current equity income, we would love to talk to you. Please give us a call.